Well, there's been a lot of talk lately about a silver-linked fund in China that suddenly revalued itself during a sell-off, and people are calling it everything from incompetence to a coordinated hit. So, in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and more confident about how you read these market shock headlines. And by the way, it's Tuesday, February 17th. Yesterday was a market holiday in the United States. So, a lot of the usual reference points people quote, like the big stock indexes and certain volatility gauges, weren't giving clean signals. Meanwhile, metals and energy were still moving in places that trade almost around the clock. That's how you get those weird mornings where one part of the world is whisper quiet and another part is screaming. And when the tape is fragmented like that, small misunderstandings turn into big rumors. Now here's what we know from the story Ingredients. This product is listed and described as open-ended, which usually makes people assume, okay, that means I can get in and out like normal, and the value should track the underlying futures. That's the expectation. But the reality is, open-ended doesn't mean immune. It means the structure is designed to create and redeem in a way that should keep prices close to value until the underlying market or the wrapper zone trading gets restricted. And that's exactly where things went sideways. The underlying silver futures market in that region has a daily move limit. Think high teens, where price declines can only go so far in a single session. When you hit the limit, the contract can basically lock. Now, some people hear that and they think, oh, great protection. But it can also be a cage, because if the local futures can't print lower, but the global silver market keeps sliding, you get a split-screen reality. The reference price is stuck, but the world price is not. And the moment you have two prices for the same thing, the story gets messy. Here's the key point most posts skip. There are three different prices in play. One is the live trading price of the fund shares themselves. Two is the local futures price the fund is tied to. And three is the fund's published value, the number that's supposed to represent what the shares are worth if you mark everything fairly. Those can drift apart even in calm markets. In stress markets, they can separate like magnets pushed the wrong way. And this is where the open-ended label can mislead people. In normal times, open-ended products have a pressure valve. Shares can be created and redeemed, and that process usually keeps the trading price close to the underlying value. In stress, that valve can stick. If the underlying futures are locked, creation and redemption can get messy. If the fund's own trading is halted, the valve doesn't just stick, it disappears. And suddenly, the product can behave like a closed-end fund, even if it isn't supposed to, drifting to a premium or discount because the wrapper becomes its own market. Now, here's a trap people fall into when they hear the fund fell over 30%. They assume the metal itself fell the same amount. But a fund's move can be amplified by two things: the mark-to-market method and the premium or discount during the halt and reopen. So, if someone is waving a percentage around as proof of something sinister, ask this first. Are we talking about the metals move, the futures move, the fund's published value, or the shares trading price? Because those can all diverge. And one more thing, a daily limit is a rule about how a futures contract trades in a session. It is not a magic shield that prevents reality. If the futures are pinned for several sessions, the missing movement stacks up. When the lock breaks, or when the fund finally remarks to fair value, it can look like a cliff, even though it's really several days being recognized at once. So the question becomes, was the revaluation a catch-up to reality or a rewrite of reality? That's the line. Now, if the fund shares keep trading while the futures are locked, the shares can start trading at a premium or discount to value because people are buying and selling emotion, not just metal. If the fund shares are halted too, then you don't even get that. You get silence. And silence in markets is not neutral. It's pressure building in a sealed container. So what does a revaluation actually mean? It usually means the administrator changes the way it marks the portfolio. Maybe it used to rely heavily on the local settlement price. Maybe it used to smooth moves. Maybe it used to assume liquidity that wasn't there. And then when the move gets violent, they switch to something closer to fair value pricing, where they incorporate broader market inputs. That can be legitimate. It can also feel like betrayal if you're the person who bought yesterday thinking the value was one thing, and then today the method changes and the value is another. So I want you to notice the psychological problem. The investor hears valuation methodology change, and what they feel is you changed the rules after I paid, even if the intent was to make the number more accurate. The timing looks terrible. Now the storyline says, the revaluation pushed the fund's value beyond what the local daily limit would normally allow. That phrase confuses a lot of people because they think the daily limit is a law of physics. It isn't. It's a rule about how the futures contract trades. The fund's published value is not the same as the futures traded price. So you can have a situation where the futures are limit locked, but the fund's value is updated using broader inputs, and the new published value implies a move larger than the local limit. That's not automatically fraud. It's the fund admitting the local print is not the full story. But again, to the trapped investor, it feels like the rug moved. Now let's talk about the halts. People treat halts like a switch that just pauses everything equally. That's not what happens. A halt is like putting a lid on boiling water. The energy is still there. It's still doing its thing. You're just preventing it from releasing in a controlled way. So, when the lid comes off, you can get a violent burst. In the outline we were given, trading was interrupted across multiple sessions on and off before it finally reopened. That matters because every extra session of You Can't Trade is a session where losses can grow while you're stuck watching. And that's why the complaints reportedly surged into the 5 figures. Not because everyone is a professional analyst, because everyone understands fairness at a gut level. Now, after this, the fund manager announced a compensation plan. And the plan, as described, tries to draw a line between smaller losses and bigger losses, making the smaller ones whole and offering partial reimbursement on the larger ones. Let me translate what that means in plain English. It means somebody decided the reputational damage was worse than the cost of writing checks, and that alone doesn't prove wrongdoing. Companies pay to calm storms all the time, especially when there's uncertainty about whether the process was fair, transparent, and well communicated. But here comes the next part of the narrative, the part that gets people's blood pressure up, the allegations. Now, let's talk about that compensation plan, because it's one of the most revealing parts of the saga. If a manager believes everything was handled cleanly, the instinct is usually to publish an explanation and let the rulebook do the talking. When reimbursements show up, the message is, even if the rules were followed, the outcome wasn't acceptable. Sometimes that's pure customer service. Sometimes it's a recognition the disclosure wasn't clear. And sometimes it's a move to avoid a bigger fight, but compensation is also precedent. It teaches investors what to expect when things break. If people start believing extreme outcomes get softened after the fact, they may take more risk next time. That's moral hazard. Now, the outline also floated a simple mechanism for the sell-off. If big holders couldn't dump shares, they'd hedge by selling what still trades, meaning the futures. That doesn't require villains. It's just survival. And when lots of people do the same survival trade together, it can create a feedback loop that feels rigged even when it's just reflex. You've probably heard versions of this before. Some players knew the change was coming. Somebody had an advantage. The market piled on. The shorts were waiting. It was asymmetric information. Okay, now we're in the zone where it's very easy to talk yourself into a story. So, let's do what we do when it really matters right now. We test the logic, not just the emotion. First question, does a valuation method change automatically mean the product was manipulated? No. It can mean the fund was trying to reduce tracking error during extreme divergence between local limits and global price action. It can mean they were trying to stop the fund from printing a fake number. It can also mean the opposite, that they changed the rules when it hurt, and somebody benefited. Both are possible. So what's the clean test? Look for whether the process was predictable. Here's what I mean. If the rulebook already said in extreme volatility, we will use alternate pricing sources, then a sudden change might not be sudden at all. It might be pre-written. But if the rulebook was vague and the change was discretionary and communication was messy, then even a good faith decision can look like a cover-up. And that's why headlines explode, because in markets, perception is a price. Now, the next allegation is the idea of foreknowledge. Let's be careful here. It's possible that some sophisticated participants didn't need a leak. They could see the divergence. They could see the local limit and the global move. They could see that the fund's printed value was becoming unrealistic. And they could reasonably guess a revaluation was coming. That is not insider trading. That is deduction. And here's the uncomfortable truth. Deduction feels exactly like unfairness when you're on the wrong side of it. So if someone tells you this proves manipulation, you should ask, or does it prove that some people understand the plumbing better? Because those two things are not the same. Now, let's talk about the claim that this was geopolitics and war. I'm going to give you a skeptical alternative interpretation, and then I'll give you the part where the geopolitical angle might actually have teeth. First, the skepticism. A daily limit doesn't necessarily mean a market is not ready to be global. It can mean the market is designed to prioritize stability for domestic participants, even at the cost of perfect price discovery. That's a trade-off, not a failure. The US market has its own versions of circuit breakers and halts too, just packaged differently. And if you've been trading long enough, you've seen those trip at exactly the wrong moment. So if someone tells you one side has no limits and the other side has limits, that's an oversimplification. Different markets control stress in different ways. Now, here's the part where the geopolitical angle can matter. If a market wants to attract global capital wants clean exits. Not always fast exits, but predictable exits. And if international investors look at a product wherein stress trading can lock and the value can be recalculated in a way that's hard to anticipate, they'll demand a premium for that risk, or they'll go somewhere else. That's not ideology. That's just how money behaves. So even if nobody is at war, the competition between market rule books is real. Now, zoom out. What this episode really showed is something bigger than one fund. It showed how fragile the link can be between a financial wrapper and its underlying reference price when liquidity gets thin and rules get binding. And we're seeing more of that fragility because over the last few years, markets have been living in a strange mix. Higher rates, faster cross-border flows, more leverage hidden in derivatives, and more products that promise daily liquidity while holding things that don't always trade cleanly. Based on recently published numbers and public market updates, the amount of money moving through passive and semi-passive products has grown massively, and that changes how stress travels. It's like widening the highways and then acting surprised when a pileup affects more lanes. Now here's a cliffhanger you should sit with. If one commodity-linked fund can get jammed up like this, what happens when several get jammed up at the same time across different assets? That's not fear-mongering, that's scenario planning. Okay, now let's shift to the second big topic that got blended into this morning rundown, the idea of an individual gold standard. That phrase sounds dramatic, and it's meant to. The core argument goes like this. You don't need a central bank to anchor your balance sheet to gold if you can hold gold in a digital form that's backed by bullion and can be used inside lending and settlement systems. In other words, you just need a wallet. Now, that claim was tied to an academic paper, and the paper's basic checklist is familiar. Backing, tight price tracking, and integration into real financial rails. If that's true, then digital gold tokens could behave like a private opt-in anchor. But here's the problem. Even if the technology works, the trust layer is everything. When someone says, "I don't care if the issuer is controversial," that's not analysis. That's a personality trait, because in a stress event, the only thing that matters is can you redeem, can you verify, and can you enforce? So I'm going to challenge the implied conclusion. Tokenized gold can be useful. It can expand access. It can speed up settlement. It can even reduce friction in cross-border transfers. But it does not magically delete counterparty risk. It relocates it. Instead of trusting a vault and a bar list, you're trusting custody, governance, and the rules of redemption. And those rules matter more than the marketing. Now, the outline also tossed in a concept that deserves a cleaner explanation. Rehypothecation. That's a fancy word for a simple behavior. The same collateral gets reused through the system, like passing one security badge around so multiple people can get into the building. It works until someone checks. So when you hear gold is being accumulated and not rehypothecated yet, what that really means is the collateral is being held tighter, not circulated as aggressively. If that's true, it matters because tighter collateral can change liquidity across markets. But here's the caution. In finance, not yet is not a moat. If the incentive to reuse collateral is strong enough, the system finds ways. So the real question isn't whether rehypothecation exists. It's whether you as a holder can see through the layers and understand your claim. And that's where tokenized gold gets complicated. In the best case, tokenization can improve transparency, clearer inventories, clearer redemption rules, cleaner settlement paths. In the worst case, it increases speed without increasing honesty, and speed without honesty just means problems travel faster. Now, zoom out to the macro backdrop. We've been living through a regime of higher rates and louder inflation narratives. While deficits stayed large and central banks tried to balance growth risks against price stability, that mix makes people chase yield and chase insurance. So the idea of a personal gold anchor becomes emotionally appealing. But emotional appeal is not the same as structural reality. Structural reality is, does redemption work in stress? Does custody hold up? And does the user have recourse? Don't buy the slogan. Study the mechanism, because slogans disappear the moment a market breaks. Mechanisms are what remain, and the broader trend is real. Traditional finance is experimenting with faster settlement and programmable collateral. That's the upside. The downside is the same as always. When systems get faster, mistakes get faster too. So, if you're excited about tokenized gold, pair excitement with skepticism. Both can live in the same brain. One more piece from that rundown matters, because it's the part that turns a market update into a worldview. They laid out a kind of playbook, almost like a checklist, and even slapped a 3-letter label on it. First, accumulate gold. Then treat that gold as collateral, then deploy or distribute it through the system, and eventually revalue it higher. And they framed it in stages. Stage 1 is simple ownership. Just hold it. Stage 2 is monetization. Use it, pledge it, borrow against it, settle with it. That's the big promise behind tokenized gold products like Pax Gold and Tether Gold. Not that they're cool, but that they might plug into credit and payments the way cash does while still being tied to metal. Now let me give you the honest take. The playbook is not crazy as a theory of incentives. Institutions do accumulate reserves. Collateral does matter. And when a collateral type becomes more accepted, its financial usefulness expands. But the leap from useful collateral to new gold standard is where people get carried away. A standard isn't just technology. It's acceptance at scale, legal clarity, and a willingness to settle disputes inside that framework. And that last part is the hard part, because if the system is under stress, everyone suddenly cares about the fine print. Who controls redemption? Who can freeze transfers? What happens in a legal fight? And whether the metal is truly there when you need it. So, yes, watch the rails, watch adoption, watch how collateral rules evolve. But don't let anyone tell you it's inevitable or that there's only one outcome. Markets rarely hand you a single road. They hand you a maze, and you find out which turns matter only after you've made them. And the next twist arrives when everyone thinks the story is over. Here's a fresh angle that a lot of people miss. The biggest breakthrough in tokenization isn't the token. It's the bridge between tokens and traditional finance. How banks, brokers, and settlement systems decide to recognize it, margin it, and accept it as collateral. And that's why you keep hearing about rails, because a token with no rails is just a souvenir. A token with rails becomes a tool. Now, the story also mentioned a big issuer claiming it holds a very large amount of gold, with the speaker even correcting themselves mid-sentence. That inconsistency is a gift because it forces the right question. If you're going to build an individual gold standard on top of an issuer, how confident are you in the issuer's reporting and verification process? That's not me being anti-innovation. That's me being pro-S survival. Because the history of finance is basically this. Every new rail creates new opportunities and new failure modes. So if you're listening to this and you're thinking, okay, what am I supposed to do with all of that? Here's the practical takeaway. Don't let big narratives replace simple due diligence. If you hold physical, understand storage and liquidity. If you hold paper claims, understand settlement and counterparties. If you hold tokens, understand redemption and oversight. Same metal, different risk profile. And here's another question for you because I'm genuinely curious. Would you rather own gold that you can hold in your hand or gold that you can move instantly, but only if the issuer system stays healthy? Tell me in the comments where you land on that. And if you've been successful navigating any of this, seriously, if you're successful, share your success story in the comments so others can stay motivated. Now, let's bring this back to the charts and the what happens next part, because that's where most people's brains go after a headline. We had a night where metals swung around like they were auditioning for a stress test, and energy did its own thing. That kind of overnight turbulence doesn't always mean a new trend is born. A lot of times it means positions are being unwound, liquidity is being tested, and the market is trying to find a level where buyers and sellers can actually meet. Think of it like a crowded room. After the lights flicker, everybody shifts. Nobody knows where the door is for a second, then the room settles. On gold, the idea described was a range, a wedge, a compression. Call it whatever you want. The point is consolidation. You can draw a line over the highs and a line under the lows and say we're coiling. And coiling does one thing really well. It builds tension. Now here's the cliffhanger. Tension doesn't tell you direction. It only tells you that when the move comes, it can come fast. So what should you watch? Not the headline, the behavior. When gold dips, does it get bought quickly or does it bleed? When it rallies, does it hold the gains or does it fade? And pay attention to something that doesn't get enough airtime, real yields. When real yields rise, gold tends to struggle. When they fall, gold tends to breathe. You don't need perfect predictions. You need awareness of the forces. On silver, the speaker's tone was different, more nervous, more exposed. That's relatable because silver is the market that can look calm and then suddenly it isn't. Silver tends to punish confidence. So instead of obsessing over one precise line, think in zones. There's a zone in the low 70s where people start to get uncomfortable. There's another zone a few bucks lower where discomfort turns into panic. And in between those zones, you often see the market try to form a home, a place where bids show up repeatedly. That's not magic, it's positioning. Some participants scale in, some hedge, some just defend prior entry points. Now, the competitor narrative implied that the China fund blow-up killed demand for silver, maybe. But that's not the only interpretation. It could also be that demand didn't disappear, it just paused. When a product fails people emotionally, it doesn't erase the underlying thesis. It changes the pathway people use to express it. They move from one vehicle to another. They move from the wrapper to the underlying, or they move to a different market entirely. And that's exactly why episodes like this can have a delayed effect. People don't always react immediately. Sometimes they sit, they stew, and then they reposition weeks later in quieter conditions. Now, there was also a quick mention of a more complex strategy structure designed for a wide range. I'm not going to tell you what to trade. That's your job. But I will tell you the principle. When ranges get huge, a lot of people make the mistake of sizing positions like the range is normal, and then they get steamrolled. So if you're going to play these markets, either reduce size, widen your expectations, or choose structures that can survive the noise. That's not exciting, but it's how you stay in the game. Energy was the other piece of the rundown, and the claim was basically oil needs to clear a specific ceiling before the fun returns. Fine, but again, don't get hypnotized by one perfect number. Watch for confirmation. If oil pushes higher and holds on a weekly basis, that's different than a 1-hour spike that fades by lunch. And watch the broader context. Energy doesn't move in a vacuum. It moves with growth expectations, with inventory cycles, with shipping risks, and with the dollar. And speaking of the dollar, here's something to keep on your radar in the coming sessions. We've got major macro catalysts coming in clusters: growth data, inflation updates, and central bank communications. Based on recent market updates, it's one of those stretches where the tape can look calm and then one release hits, and suddenly everyone remembers leverage exists. So don't fall asleep just because the open looks quiet. And a quick note on timing, because holidays can distort how this all feels. Some data hits while cash markets are closed, futures keep trading, and then the reaction gets delayed until the next full session. So don't anchor to a single today. Anchor to a window. Over the next several sessions, growth data, inflation updates, and central bank language can flip sentiment fast, especially when the market is leaning one way. Now, we've covered a lot, so let me tie the whole thing into one clean thread. The China Silver Fund event is a reminder that liquid can be conditional. The tokenized gold thesis is a reminder that digital can still be counterparty. And the charts are a reminder that range is not the same as safe. If you want one mental model to carry with you, it's this. Markets aren't just prices, they're rules. And when rules collide with volatility, that's when people learn what they actually own. So, here's my final cliffhanger for you. If this is what a single valuation method tweak can do to one product, what happens when the next stress event hits multiple products at once? That's the question. That's the risk. And that's why we do these breakdowns. If you got value out of this, hit subscribe and comment RJAG so I know you're here. And so the copycats see it too. Thanks for watching, and I'll see you in the next video. And just to be crystal clear, nothing in this video is financial advice. I'm sharing my own market interpretation for educational purposes so you can think more clearly and ask better questions. Always do your own research. And if you need personalized guidance, talk to a qualified professional before you put real money on the